The Federal Reserve just fired a starting gun that every serious investor, personal finance enthusiast, and wealth builder should hear loud and clear. On September 17th, Chair Jerome Powell announced a fresh interest rate cut, describing the move as a way to support a sustainable expansion and to keep the labor market strong while bringing inflation down. And here's the bigger headline. Powell hinted that multiple cuts are anticipated before the end of 2025, saying the Fed is prepared to adjust policy as appropriate to sustain growth. This isn't some dry policy tweak, it's a massive shift in the cost of money itself, and it touches everything in your financial life. When the Federal Reserve lowers interest rates, borrowing gets cheaper, business capital flows faster, and markets pivot in ways that can open rare windows for wealth building. Home buyers rush in, companies invest aggressively, and the stock market often reacts with powerful moves that can create new chances for passive income and financial independence. For anyone serious about money management, investing, or learning how to profit from the stock market, this could be your wake-up call. Lower rates can supercharge exchange-traded funds, individual stocks, and dividend strategies. Whether you're exploring ETF investing, sharpening your stock market tips, or refining a long-term strategy for financial independence, this environment rewards those who know how to invest and act early. History proves it again and again that every major Federal Reserve rate-cutting cycle has rewarded investors who position themselves early, especially in small-cap stocks. These agile, fast-moving companies thrive when borrowing costs fall, because cheaper capital fuels innovation, expansion, and quick pivots that bigger corporations can't match. After past Fed cuts, small-cap indices have frequently surged more than 15% within a single year, nearly doubling the 8 to 10% average gains of large-cap stocks. That isn't hype, it's decades of hard market data. And here's the best part, you don't need to gamble on individual tickers to capture that upside. Exchange-traded funds focused on small caps let you diversify instantly while riding the entire wave. For investors who are serious about wealth building and passive income, this is the kind of opportunity that can accelerate financial independence. Today, I want to share 3 standout small-cap ETFs that have been getting serious attention ever since the Federal Reserve signaled upcoming rate cuts. In addition, I will also provide a breakdown of how a $100,000 investment in 3 carefully selected real estate investment trusts, commonly referred to as REITs, could potentially grow into a portfolio worth more than $3.2 million while paying around $190,000 a year, or roughly $15,000 every month, in dividend income. Make sure you watch this video from start to finish so you don't miss a single detail. Before we continue, please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. In addition, all projections in our content are based on historical returns, growth rates, and performance. But also remember that past performance does not guarantee future results. Always consult a qualified financial professional before making any investment decision. Every investment involves risk. Welcome to Trailblazers Mindset, where wealth builders come to get inspired. Let's dive in. The first exchange-traded fund is the iShares Russell 2000 ETF. I call it the Broad Small Cap Power. The iShares Russell 2000 ETF, ticker IWM, gives you instant and affordable access to the entire U.S. small-cap market, blending growth and value stocks inside one highly liquid fund that tracks the Russell 2000 index. This ETF is built for long-term compounding. Over the next decade, analysts expect annual growth of roughly 8 to 12%, and if you stretch the time horizon to 20 years, the annualized growth rate could land between 9 and 11%. That combination of diversification and steady potential makes IWM a simple but powerful way to capture the full energy of America's small businesses. Next is the Avantis US Small Cap Value ETF. For investors who want to uncover overlooked opportunities, the Avantis US Small Cap Value ETF, ticker AVUV, focuses on small companies that generate solid earnings and strong cash flow, yet remain off the radar. By focusing on value-oriented businesses poised to thrive as the economy expands, AVUV offers impressive growth potential. Over the next 10 years, returns could reach 10 to 14% annually, and looking out 20 years, annualized growth is projected at 11 to 12%. Its disciplined focus on undervalued companies gives AVUV a track record of outperforming broader small-cap benchmarks when market conditions favor value investing. The third is the Goldman Sachs Small Cap Equity ETF. If you prefer a more selective approach, the Goldman Sachs Small Cap Equity ETF, Ticker GSSC targets high-quality growth names and leverages Goldman's deep research expertise to identify small companies with exceptional management and robust expansion potential. Analysts see the fund delivering around 9 to 13% annually over the next decade and 11 to 12% over a 20-year stretch. By concentrating on carefully chosen growth leaders, GSSC combines the dynamism of small caps with the discipline of professional research. In case you want to stretch it further to 30 years, that's after accounting for reinvested dividends and inflation, these three ETFs are still projected to generate roughly 8 to 10% annual returns, with AVUV and GSSC offering slightly higher long-term upside thanks to their value and quality growth tilts. These projections aren't wishful thinking. They're grounded in decades of market data. Research from Riverfront Investment Group shows that U.S. small-cap stocks have historically grown about 8.2% per year, outpacing large caps at roughly 6.4% when valuations are attractive. AVUV's own performance reinforces this story, with a compound annual return of approximately 10.96% over the past 30 years. Meanwhile, IWM's 10-year total return through September 2025 highlights the strength and resilience of small-cap investing. As stated earlier, now I'm going to show you exactly how a single $100,000 investment could grow into more than $3 million and pay you nearly $190,000 in annual dividends. No hype, no guesswork, just a plan built on 3 rock-solid REITs. Think of this like a 3-legged stool. One leg gives you income today, another fuels long-term growth, and the third locks in stability. Before we continue, if you find value in this video, even if just a little, please subscribe to help us continue to create top-notch educational content. We appreciate your support. Thank you. Ready to see how the pieces fit? Let's dive in. Pillar 1. Income with gaming and leisure properties. Ticker symbol GLPI. Gaming and Leisure Properties owns and leases casino properties under long-term triple net agreements. That means tenants handle everything: taxes, insurance, maintenance, even utilities, while GLPI simply collects rent. Those leases run 10 to 15 years, often with built-in rent bumps. This is dependable cash flow in action. Over the past decade, GLPI's share price rose a steady 25%, and that's the point. It's designed to pay, not to skyrocket. Right now it yields a 6.74% dividend, growing at an impressive 3.87% annual rate. Institutions clearly see the appeal. They own more than 95% of the shares, and analysts give it a consensus buy rating, with about 19% upside. GLPI is my income engine, delivering money every month and slowly raising the bar year after year. Pillar 2 is growth. This is crucial because income today doesn't matter if your portfolio isn't compounding for tomorrow. Extra Space Storage, ticker EXR, is the largest self-storage REIT in the United States, operating more than 4,000 facilities and nearly 3 million units, from recreational vehicles to business inventory. It runs with surgical efficiency, using advanced pricing algorithms and the power of a strong national brand to stay ahead of competitors. Over the past 5 years, its share price has gained 48%. Its total return over the last decade has reached 123%, and its average annual price growth has been about 8%. The dividend is equally impressive, offering a 4.25% yield with a remarkable 13.17% annual dividend growth rate over the past 10 years. Institutional investors own more than 98% of its shares, a clear sign of professional confidence, and analysts maintain a positive outlook with no sell ratings and a price target that points to additional upside. EXR is the growth engine that keeps a portfolio compounding at a faster rate year after year. The final pillar is stability. This is the glue that keeps everything steady when markets get messy. That's where Agree Realty Corporation, ADC, comes in. It owns over 2,400 properties across all 50 states, leasing them to necessity-based retailers like pharmacies, grocery chains, and dollar stores. These tenants aren't trendy startups. They're essential businesses that stay busy in every economy. ADC locks in long-term net leases with near-perfect occupancy. Institutional ownership, 98%. The stock gained 22% in the past year and has delivered a 150% total return over 10 years. Its dividend yield stands at 4.06%, growing 5.56% annually for a decade. Analysts love its conservative balance sheet and still see about 9% upside. ADC is the ballast, the calm in every storm. Now that we have analyzed the individual strengths of each of the REITs, let's examine how they work together as a unified investment portfolio. By allocating equal portions to each REIT, The combined portfolio demonstrates well-balanced investment characteristics across key performance metrics. By the way, the calculation is straightforward. GLPI pays a dividend yield of 6.74%, EXR offers 4.25%, and ADC provides 4.06%. With the portfolio evenly split into one-third investments in each REIT, you first add their yields, 6.74 plus 4.25 plus 4.06, to get 15.05. Dividing that total by 3 gives an average dividend yield of 5.02%. Using the same approach, the portfolio's dividend growth rate comes out to 7.53%, and its average annual share price appreciation is 6.62%. Now let's run the numbers. If the original $100,000 to be invested is divided evenly into 3 parts for each of the ETFs, after the 10th year, your investments could grow to roughly $366,000, a remarkable tripling of your starting amount in a single decade. At the 20-year mark, the portfolio could swell to nearly $982,000, pushing you ever closer to millionaire status. And by year 30, the initial $100,000 could expand into a stunning $3.3 million. By that time, the portfolio could be generating approximately $190,000 per year, or roughly $15,800 every month, in pure dividend income, money you can live on comfortably without ever selling a single share. The Federal Reserve's decision to cut rates isn't just an economic headline. It's an open door for investors who are ready to act. Lower rates reduce borrowing costs and inject fresh liquidity into the market, giving small caps, real estate, and dividend-focused assets a powerful tailwind. Historically, periods following rate cuts have delivered above-average returns as growth accelerates, and capital flows back into risk assets. This is the moment when undervalued stocks can surge and high-quality REITs can lock in cheaper financing, driving both income and appreciation. Waiting on the sidelines means watching others capture that upside. By positioning your portfolio now, with a thoughtful mix of income generators, growth engines, and stable anchors, you can harness this window of opportunity before the next expansion cycle kicks into full gear. A Fed rate cut could be your signal to invest strategically and build lasting wealth. If you're serious about building real wealth, then consider this channel as your financial gym. Every video is a workout for your portfolio, your mindset, and your money skills. If today's video helped you level up your financial education, even just a little, please smash that like button and subscribe so we can continue to grow and build wealth together. Please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. In addition, all projections in our content are based on historical returns, growth rates, and performance. But also remember that past performance does not guarantee future results. Always consult a qualified financial professional before making any investment decision. Every investment involves risk. Click on the next video on your screen. We appreciate your support. Thank you.